Going and joining us is Larry Shover, Chief Investment Officer at SFG Alternatives. Larry, good to see you. On a day where we're watching, again, fresh record highs for these markets in the U.S., this slow grind higher just seems as if it's never going to end.
Yeah, it seems that way. Consider that we've rallied like 230 points, 12.5% since October the 15th. Basically in a straight line. We've had maybe 6 declines between today and October 15th, and people are saying, like, why? It seems to be the same narrative is in place, that growth numbers out of the U.S. and China are okay. No worse than feared numbers coming out of Europe. We had a really good earnings season, accommodative central banks, and there you have it. We're back to the sentiment that everybody's more scared about the missing 2,100 in the S&P than they would be being caught long at 2,000.
Yeah, but it's interesting because it's not as if people are piling money into this market. It's not as if volumes are high and the excitement is ripe. So it's not quite, the traditional type of bull market, is it?
No, you're exactly right. It's a slow grind higher, although we're not seeing a whole lot of downside momentum. Whenever we see an air pocket, it quickly fills in with willing buyers. But you're right. There's not a whole lot of liquidity, a whole lot of action on the trading floor, and there hasn't been for quite some time.
So what is this telling us? I mean, what's your market view right now? Fundamentally, we have a U.S. economy that appears to be picking up, but really, it doesn't feel that exciting.
No, exactly. Very boring. And what's happening in my market view are probably two different things. I think we're being lulled to sleep with the market grinding higher. Everybody thinks the coast is clear, it's safe. Going forward, I do believe 2015 will be similar to 2014, where the U.S. will continue to lead the way with economic numbers, and we'll grind out another gain in the S&P 500. But I do think the sledding is going to be a lot different, a lot harder than we've had in the past, and it's going to be full of a lot more volatility, similar to what we saw back in October. So, yeah, I'm constructively cautious, but ultimately bullish on the stock market in the U.S., but I don't see much more than higher single digits.
What do you make of the read we saw on producer prices through the session there? Obviously not pointing to any real inflationary pressures.
No, that's true, and that is one of the biggest problems. But I think that the headlines, the media, the traders on the floor, portfolio managers are a lot more worried about that than the Fed might be, and we'll hear a lot more about that tomorrow with the minutes. But it would be great to see a little bit of inflation. We're not seeing it, but again, the Fed doesn't seem to be very concerned about it.
Now, there's a lot of talk about how the tightening jobs market will push up wage inflation. But, is that likely when you consider the types of jobs that are being created in the U.S. economy, when you look at the level of part-time job and the level of participation as well? Is it likely that we're going to see this real wage pressure coming through? Why would U.S. companies really feel compelled to pay more?
Yeah, that's a great point, and that is like a sore spot here in the U.S. because we are lacking labor supply, wage growth, wage growth, is not where it should be. But I do think eventually, if the numbers continue the way I think they will, that we will ultimately see wage growth, and I do believe that will end up ultimately taking away from price multiples in the stocks. And so right now, the S&P 500, looking at next year's numbers, we're talking about a 15.5 times forward-looking EPS. Any higher than that, I think that gets a little bit high, given the environment we're in. So it could be very treacherous indeed. And yes, I do believe we will see some wage inflation ultimately by the middle of next year.
Okay, just looking at some of the other economic, indicators out there, you probably heard me mentioning off the top, we're getting some breaking news coming from an Australian house builder, James Hardie. It's saying in its commentary that it continues to expect improvement in the U.S. operating environment in fiscal 2015. It's leveraged obviously to the housing market, although at a more moderate level than originally assumed for the year. What do you make of that commentary?
Well, I've taken a lot of grief for that because, you know, in 2013 and today, I've been very bullish on the U.S. housing market. And really, I think a lot of people got overly excited given how well it did the last half of 2013. But I, just like James Hardy, just have to sit back and realize this is a multi-year expansion. It's not going to happen as quickly as we'd like it to. Like looking at the stock market, I mean, the housing market's quite different. In the United States, the housing recovery is very uneven, very much so uneven. But I do believe long-term it's constructive. I do believe the beneficiaries of that will be the financials and materials, but it will not happen overnight, and it has not. Let's keep in mind we've fallen down a 6-year flight of steps, and we're just like 2 years into climbing back out of that.
Okay, and just quickly, get your thoughts on oil. Again, seeing it tumbling through the overnight period. We've got Venezuela calling for an OPEC meeting and a non-OPEC meeting to address the global supply-demand conundrum that really is taking hold and affecting a lot of those small caps over in your neck of the woods. So what is your sort of fundamental assessment when it comes to the oil price? When are we going to start seeing some sort of a turnaround? Because with Brent and crude sort of below that pain threshold for producers, there has to be some sort of a breaking point at some point.
Yeah, I think the breaking point is whether we see exports firm up out of the Atlantic Basin, because that's been like the trouble spot for everything, just adding insult to injury to the amount of supply overhang that we've seen here in the U.S. The other one clearly would be the U.S. dollar, and we can blame basically just about every commodity performance on that at this point. So if we have like the U.S. dollar starting to consolidate, I mean, in my opinion, it's definitely overshot most of the majors right now and most matrices. With that in mind, we could clearly see the oil bounce from here. But on the other hand, if the dollar continues to rally higher, if we don't see any kind of emerging market growth that provides any kind of import out of the Atlantic Basin, then clearly $70 or even $65 a barrel is coming into view very shortly.
Very painful that would be. And just quickly, so I guess now what we're waiting for is the minutes from the U.S. Fed. That's the next big one on the horizon.
Yeah, and it's funny because they used to just keep the market hamstrung until those minutes came out. But most recently, nobody has cared until now. And tomorrow, people are wondering, you know, the last minutes, the last meeting was definitely a little bit hawkish. Are they going to remove language? Are they going to be a little bit more specific? So you see asset class volatility has perked up a little bit, anticipating once again those minutes.
Larry Shover, always great to chat. Thanks for coming on. We'll see you next week.
Thank you.
Larry Shover
Thank
there
you.
joining us.